And welcome back this morning at 6:34. And one guy that's really happy that the Nationals won last night, Michael Leibowitz, CFA.
And one very tired guy that's happy.
Well, that's your home team.
It is. They won. Big win. But, the game ended, 12:30, 1 o'clock. And then, of course, you can't sleep, so I'm up till 1:32 watching highlights.
And then you're up at the crack of dawn this
morning. Turn around and get on Lance's show.
Exactly.
All good.
Got to keep you going. All right, Mike. Mike wrote an article yesterday. It's out on our website right now called the millennial perspective about the markets, right? The millennial view, and it's an interesting article because it's something that we've talked about before. Because we've lived through a stock market now that's going on 11 years of a bull market advance. Been struggling for the last year or so, but still within a bullish trend, still going up. And a lot of the belief for investors is simply that, bear markets are a thing of the past. The Fed, as long as the Fed can cut rates and do QE, we're not going to have we can't have a recession and we can't have a bear market because central banks are going to, bail this out. Mike, it's an interesting, conversation because, when you look at what happens during, really big bear markets, 2001 and 2, 2008, there's a big chunk of the advisors that are giving people financial advice and managing money, those type of things, that are not in the business after those bear markets occur for one reason or another. Right. Then there's a whole new group of individuals that come in that have never seen a bear market. And that's really kind of an interesting dynamic that we're now. 13.3 million newly minted financial advisors have entered the financial business in some form or another just since 2009. There's a large number of people in the mainstream media writing articles, journalists, etc., writing articles about the markets, about the economy, about investing, that have never actually been through a bear market. They may have seen one with their parents, but they've never actually been investing and have lived through a bear market to have that impact.
Right. Right. The oldest of the millennials was only in the mid-upper 20s during 2008, 2009. Mm-hmm. So, yes, a few of them were working, a relatively small portion of the millennials, but none of them really had skin in the game. None of them had too many clients. None of them, they lost money, but they didn't have enough money accumulated to lose to be that painful. Mm-hmm. And what's happening is this millennial generation over the last 10 years has become a much more powerful generation as they get older. That right now that they're in their 20s and 30s, upper 30s for the oldest ones. Mm-hmm. So they are becoming the large majority of many industries, of the financial industry. Their voice is carrying. They also, this is the generation that created social media, Twitter, Facebook, on down the line. Mm-hmm. So this is a little different than past generations in how they gain a voice, because their voice is being amplified by social media, which is new, and they predominantly control. It's not to say there aren't others, right, that are like Jim Cramer. Right. He's also a buy and hold perma bull, and he's certainly not a millennial. But the point is that we do have a large population that is driving the market narrative. And what the article does is basically look at this generation and look at their perspective. Mm-hmm. And based on their perspective, you can see why they are very bullish, why they have this feeling of invincibility, because they really haven't seen a recession, and they've seen a very, very active Fed and government that will do whatever it can to avoid a recession.
Mm-hmm. So it's an interesting kind of conundrum almost, is that, you're talking about a very large group. The group of millennials that are coming through the system now are as large as the baby boomers that are leaving the system, right? So we've got this large group of people that are retiring. They're coming out of the rolls. They're moving into retirement and dying off. And then you've got this large group of individuals that are now kind of really coming into the workforce. And again, they have a very kind of distorted view about how the markets and economies really work because of all this central bank intervention that we've had. We've never actually seen the economy itself actually functioning on its own two legs, right? We never get, we bailed out banks, we bailed out corporations, we've done everything we can to support housing. So they've never actually seen the economy working on an organic basis. It's been, a lot of this has been, almost an illusion because of the rampant stock share buybacks that have elevated stock prices. I mean, we've had just all these distortions that have occurred at one time that we've never actually seen before in history.
Right, right. And these are the people this generation is advising other people with their money. And they have a perspective that isn't unique. This has gone on throughout history. It's just their perspective is very different. And if you really think about it, anyone that was alive during the Depression, even kids, have a much more conservative, saving money attitude. It's almost polar opposite of the generation, and that perspective for a long time ran the markets, and that's long gone. But we're now dealing with the millennials and their perspective. One of the things in the article, I start off. Lance, you and I have been in this business for over 30 years each.
Right.
And neither one of us have seen a bear market in bonds.
Right.
Bond yields have gone down for 40 years. Right. So they started going down when we were teenagers or maybe even before that.
Right.
So it's natural that our perspective is, you just buy bonds. They're always going to protect you from the stock market. They always go down in yield. So not only, yes, you make a little bit less of a coupon, but you make some price gains, and bonds are always there to protect you. And it's easy to see as someone that has been involved in that's the case.
Right.
And you can apply that to the millennials with the stock market.
Exactly. And it's interesting when you talk about when you talk about bond yields in particular. Yes, they've gone down for 40 years, and we're talking about the potential for a reversal of that. Seeing a bear market in bonds would mean interest rates that were going up rather substantially, like we saw maybe in the 70s, the late 70s, last time we really saw a big bond bear market. But, you look around the world and you've got, almost 17 trillion of debt or more that are actually running in negative rates. In other words,
Right.
So not only did rates go to zero, they went negative, and currently we're still yielding about 1.5%, 1.6% roughly on the 10-year Treasury, some of the lowest levels in history. But it doesn't mean we can't go 1.6% lower at this point.
Or 3.6% lower.
Or 3.
I'm not sure there's a zero bound.
Yeah.
Correct. But what I would say is the decline in bond market yields is much more related to fundamentals. Economic growth has slowed for the last 40 years on average.
Yep.
Inflation has declined for the last 40 years on average. So bond yields are tracking the economy and inflation.
Yeah.
Whereas equity markets, equity valuations, which we've both talked about for a long time, and we write about all the time, are at levels that just don't make any sense. Investors are just paying too much for what they're getting. And it seems crazy to say that a 10-year at 2% is a great deal, but it's a fair deal.
Right.
And you're kind of getting what you pay for.
Well,
whereas that's not true for stocks.
Well, and I think that's a great point. when people look at the Treasury, they go, oh, I saw an article out the other day. A guy was emailing me and he was saying, said bonds are clearly in a bubble. Bonds can't really be in a bubble. And the reason that they can't be in a bubble is that bonds mature. They have a finite value to them when they mature. So you get what you pay for. So if you're way overpaying for a bond, you're going to get very low yield, but that going in. The great thing about bonds is when I buy a bond, I know exactly to the 100th of a penny of what I'm going to get at maturity when that thing matures and comes back to me. So theoretically, bonds can never be in a bubble because there is a definitive value and people know what they're getting as soon as they buy it. So it's always basically a fair value based upon the economy, inflation, and assumptions. Not the case with the stock market where there is no terminal value.
I would walk that back a little bit. Treasuries will always mature at par. But we are seeing somewhat bubble activity when we look at junk spreads.
Well, this is true. We should clarify. Yes, when we're talking about Treasury bonds. Yes.
Right, and even high-grade corporate bonds are obviously you got to do your work and find the right ones, but a large majority of them will mature. You will get your money back.
Yeah, it's the same thing with stocks, though. You have to assume no bankruptcy. If you're paying 40 or 50 times earnings, you've got to assume no bankruptcy risk, right?
Correct.
So, all right, quick break. We'll come back. We'll pick up more with Mike Leibowitz. Talk a little bit about trade. We're going to talk about QE, not really QE. What the Fed says is not QE is QE. Well, I'm so confused. I don't even know anymore. We'll be right back after the break.
Catch the best of The Real Investment Show anytime, anywhere from Stitcher Smart Radio. Download podcasts of The Real Investment Show from Stitcher.com.
You gotta love the headlines on the media this morning. S&P having worst week since August 23rd. We've got to go all the way back to August 23rd to have the worst week that we're having this week so far. Could change in a heartbeat. We're about 3% off of highs. We need to keep this on perspective, right? So talk a little bit about here what's going on. Two things in particular that's happening currently right now. I kind of talked about this a little bit in the show or earlier in the show today is that, trade is on again, off again, on again, off again. And apparently we're not going to get any type of trade deal, but now maybe we get a trade deal on some type of currency that allows us to manipulate our currency, but they can't manipulate their currency. In exchange for that, we won't hike tariffs. So sounds to me like China just won a huge deal.
Yeah, it's hard to, first of all, we got to be careful reading these headlines. Last night, before my Nats game, I was the bigger roller coaster was not the Nationals game and their comeback victory, but it was actually the headlines going back and forth saying the Chinese trade delegation left, they're going home, no, they're coming back. There's some kind of deal that involves the U.S.'s ability to cheapen our currency, maybe reducing tariffs, and the market was down 20, went back to flat, down 10, and it was just whipping around.
Yeah.
But again, it's a lot of rumors. Who knows what's real, what's fake, and we'll find out. It seems like we should find out over the next day or two what's really going on. And if you are trading the markets, we advise that you just sit on your hands and let this play out at this point.
Yeah, that's what you and I have been talking about the last couple of days is the markets have had 4 down weeks. From a statistical basis, the markets are due for a bounce. What that means is something else. What kind of bounce it is, but things have gotten compressed here a little bit as of late. But we need to keep this in perspective, right? I mean, the markets are only 3.5% off of all-time highs, and the media is acting like we've had this major bear market over the course of the last couple of weeks. This is really the markets just haven't gone anywhere really in the last 18 months. We wrote a piece on Twitter just the other day. If you had invested in the Dow Jones a year ago, you're about 1.5% lower than you were a year ago. The markets have simply just have been flat for a year and a half, despite this massive rally from, December the 24th lows to where we are currently. You're at the same levels you were a year ago. So all you did was kind of get back to even. And this is kind of the frustrating thing because a lot of investors are hearing headlines, oh, the markets are up, 18% for the year or whatever the number is. But that's only year to date. All you wound up doing was just getting back what you lost last year because of hopes of trade deal and QE from the Fed, which is really kind of the next issue here, which is Jerome Powell coming out yesterday saying, we're going to be providing more liquidity for the markets, but don't call it QE because it's not QE. If you're expanding your balance sheet, it's pretty much QE. Am I wrong?
Oh, you're absolutely right. But first, think about this, Lance. So year to date, the market's up upper teens, 17, 18%, whatever you may have just said. Year over year, so if you go back to October 10th, 2018, the market is flat or lower.
Right.
So that's just stunning.
Yeah.
That 3 months makes that much of a difference. So I started writing an article yesterday for our RIA Pro subscribers with a trade recommendation. And the title of the article, or at least the title of my draft right now, is Non-QE QE, How to Trade It. And the reason I wrote that is because Chairman Powell came on a couple days ago in a speech, and he basically said the Fed is going to do QE to alleviate the repo funding situation that we had talked about a couple weeks ago. But it's not QE. Don't ever call it QE. It's something else, even though it's It's the same operationally, and the effect that it will have is QE. It's the same thing as QE.
Right. So basically, because it has a bill, web feet, and quacks, don't call it QE.
Right. It could be something else.
Could be an otter.
It doesn't oink or moo. It doesn't oink or moo or purr, but it's still not a duck.
Exactly. So, but I think that's the interesting thing here. By the way, for everybody that's listening to you right now, a couple of things that you said is important. We have an article on our website talking about repo. So if you don't understand what's happening with repo, it's actually a very important thing. Banks are having an inability to borrow money on an overnight basis, even though it's fully collateralized. We touched on this yesterday. Used the example that I wanted to borrow $10,000 from Danny. He was here with me yesterday. I said, I've got a Mercedes AMG in my driveway, $100,000 car. I want to borrow $10,000 just overnight. You can keep my car as collateral. If I don't pay, you can go sell the car. Here's the title. And Danny says, okay, great. I'll lend you the money, but it's 7%. When going rates are, 1.5 or 2. So, it just goes to show you that there's something broken in the system somewhere that is causing a funding problem for these banks. And the Fed has had to intervene to the tune of over $100 billion now, trying to supply liquidity for these banks. Something has happened here just in the last couple of months that has changed the dynamics of reserves with banks. And we probably won't know what it ultimately is. If there was a bank in trouble or something, maybe for a few months or a few quarters, they'll eventually probably come out in the press somewhere. But something is definitely kind of gone awry here. So we have an article on our website. Simply just go to the website in the search bar, just type in repo, and you'll find Mike's article on that. But he also mentioned this trade article he's got coming up on how to play this for our RIA Pro subscribers. If you go to our website, realinvestmentadvice.com, there's a link on the right-hand side for RIA Pro, and you can subscribe for free for 30 days. Try it out. It's a great research system for managing your own money, but that's where we publish a lot of our specific trading ideas to take advantage of opportunities like this. And so this is something that Mike's producing, and it'll be out in the next day or so. But Mike, I guess the question here ultimately is that whether it's QE or not QE, the bottom line is that the Fed is providing liquidity to the markets. They are expanding their balance sheet. And, longer term, the question is simply going to be whether or not lowering interest rates and more QE is going to have the same effect as what people have been hoping for that they saw back in 2010, 2011, 2012 when we were doing QE and the markets were having a big run. Will you get the same effect for that given a very late stage market cycle, high levels of confidence, high level of stock ownership, which you didn't have previously? Basically, the economy and the investing environment is diametrically opposed to what it was, a decade ago, and you're expecting the same type of results. Right.
This is not QE4 is not the same as QE 1, 2, and 3. At least, it is operationally the same, but you're right. It's in a very different environment. And to expect the same thing is, it's a toss of a coin, right? We don't know because a lot of it's just behavioral. And if the market believes that it's QE and it will have the same effect, it can have the same effect, at least for a while. But if we're at valuations that don't make sense, that was not true with the other QEs.
Right.
There's the government is borrowing over $1 trillion a year. Some of that was true with the earlier QEs, but we were in crisis mode. We're not in crisis mode. And the Fed funds rate, the short-term rates are still 2%, 1.75%. Fed funds were 0 when they did QE 1, 2, and 3.
Right.
So, and it's also, this QE is a little different, and I will give that to Powell, in that it sounds like they're going to buy short-term treasuries, not long-term treasuries. So the investors that get displaced, whose bonds they buy, will likely stay in very conservative money market, short-term, safe instruments, as opposed to moving out into either higher, lower-rated credits or, eventually into the equity market. So it is a little different in that respect, but it's still operationally, it's identical to QE, no matter what anyone tells you. And I'm not backing down on that, Lance.
It quacks, so it's probably QE. But no, look, this is all, kind of very confusing stuff for most investors. Let's break this down just a little bit, make this very simple for people to understand, is that everybody pretty much, I think most people have a basic understanding the Fed's been doing something to boost markets and keep markets going up. And from this perspective, what they're trying to do now is by lowering interest rates and doing these injections, again, trying to keep markets elevated. They want consumer confidence to remain intact, because if you lose consumer confidence, you wind up with a recession. That's 70% of the economy is consumer confidence. So the whole point of this is try to keep consumer confidence elevated. The important kind of consideration here is not to be overly confident, though, about just because the Fed is doing this, that means the market's going to go up another 300%. Be super aggressive with your investing. There is a more than significant chance that these operations don't work as intended, and we still wind up in a recession and a bear market anyway at some point. Maybe it's milder than it would have been otherwise, but nonetheless, there's a real possibility here that may still occur.
Right. Again, it's behavioral. And you know what, Lance, we've seen it, right? Mm-hmm. The last couple of days since he pretty firmly said that they're going to do this form of QE, mm-hmm. the market really hasn't gone up, and it didn't even really spike. It spiked for minutes, minutes, less than an hour. I mean, a lot of trade news going on, so it's not completely fair. But the market has not spiked on the fact that they are doing QE.
Right.
So that may be, it's very early in this game, but that may be a first sign that this QE is not going to act like the prior QEs.
Right. And again, you're absolutely right. There's been a lot of trade news that's kind of really been kind of obfuscating that headline. But if the belief is that QE was the be-all, end-all, cure-all, then trade wouldn't matter, right? And the market would have just taken off running, and we'd be back to new highs by now, regardless of what the trade news was. But to your point, that hasn't happened, and the actual trade news has been really even dominating the Fed comments as of late, which suggests that what's happening with trade right now is potentially more important. So just to recap a little bit about what we talked about earlier, is that this is a very kind of fluid environment. So the best thing to do when you're not really sure about what's going to happen is to do nothing. And just simply to wait. Let's see what the news is going to be. Let's see how the markets react to it, and then we can make some adjustments from there. We've been holding extra cash. We've been long, treasury bonds. We've been long duration and credit risk. These are the things that have kind of helped hedge portfolios up to this point. And now we have the ability to sit and wait and look for the next opportunity where it presents itself with a little bit of safety. That wraps up the show for today. Thanks for joining me, Mike Leibowitz, CFA. And, of course, get by the website. All of our articles are on the website now, talking about the millennial view as well as the myth of capitalism. They're all on the website now, realinvestmentadvice.com. And as I said earlier, there's a link for RIAPro.net, which is our subscriber service for professional investors and you to help you manage your money better. It's a complete research system. Realinvestmentadvice.com. You'll find it all there. We'll see you next time on the next edition of The Real Investment Show. Chris Salcedo coming right up.
It's a rich man's world.